Welcome to this explainer. Okay, today we're going on what I like to call a cinematic treasure hunt. Forget the stressful minute-by-minute anxiety of day trading or trying to perfectly time the market's unpredictable swings. Instead, we're searching for the ultimate map to exponential wealth. We're unpacking the really fascinating principles from Christopher Mayer's study on 100 baggers. You know, those incredibly rare stocks that return 100 times your initial investment? Okay, let's dive right into this. Just let the absolute awe-inspiring math of that number wash over you for a second. 100 times. This literally means that a pretty modest investment of, say, $10,000 transforms into a massive $1 million fortune. It's the kind of math that sounds like pure magic, right? Like alchemy. But as we're going to see, it's actually entirely grounded in hard business fundamentals. So that brings us to a really provocative question. How exactly can a single, well-chosen investment create true generational wealth? Because listen, we aren't talking about gambling here or getting lucky on some speculative hype cycle. No way. We're talking about finding and holding on to exceptionally rare business gems that silently compound over decades. Section 1. The Math of Patience. Now to really wrap our heads around how exponential growth works, just look at the stark difference in these time horizons. If a company grows at 14% a year, well, it takes 35 years to hit that 100x mark. But if you can find a business growing at 20% annually, that timeline shrinks to 25 years. Bump that up to an incredible 36% growth, it only takes 15 years. And in those truly exceptional best-case scenarios growing at 48% a year, a stock can literally become a 100-bagger in just 10 short years. So time and growth rate, those are your absolute twin levers here. But we've got to anchor this data to reality. Think about it. If a stock takes 50 years to grow 100x, it might just be keeping pace with historical inflation rates, which means you're basically just preserving your purchasing power, rather than building massive new wealth. A true 100-bagger vastly outpaces inflation in a much shorter time frame, say 20 to 25 years. And honestly, that's the fundamental difference between the calm, visionary investor who builds true wealth and the stressed-out day trader who's just spinning their wheels. All right, moving on to Section 2, Lesson 1. Leaders with vested interests. So picture this. On one side, you've got your typical corporate CEOs. They're pulling massive salaries to fund their yacht collections, but they actually hold very little company stock. They're totally incentivized by short-term bonuses, right? Now, on the flip side, you have visionary founders like Elon Musk, who famously takes a $0 salary, or Warren Buffett, who has taken a really minimal salary for decades. Why? Because their entire net worth is tied strictly to the long-term compounding of their company's stock. They've got real skin in the game. And we can see this exact dynamic playing out in real-world examples globally. Look at the Indian consumer giants highlighted in the source material, like Relaxo Footwears, where promoters hold 70% of the company, or Marico Industries sitting at 59%. When the founder's wealth is that highly concentrated in the business, they naturally focus on long-term survival and sustainable growth, rather than just short-term stock manipulation. And here's the best part. Their massive insider ownership actually protects the everyday investor from corporate fraud. Because, if they cheat, they're ultimately just robbing themselves. Which brings us to Section 3, Lesson 2, the Reinvestment Growth Engine. Okay, so now that we've found good management, we need to look for what's called a reinvestment opportunity. Think of it kind of like a massive redwood tree. It doesn't grow to be hundreds of feet tall by spreading its nutrients randomly all over the forest, right? No, it grows by continually nourishing its own soil and funneling its energy straight upward. A 100-bagger absolutely must have that rare ability to take the cash it generates and plow it right back into its own highly profitable business model. That is what fuels exponential expansion. Now, here is where we're going to challenge some conventional wisdom. We constantly hear that high dividend stocks are the absolute holy grail of investing. But wait, if you're hunting for 100-baggers, a really high dividend payout can actually be a massive red flag. Seriously, it often signals that the management team simply lacks internal high-return opportunities to reinvest that cash. By paying it out to you, they're essentially bleeding the exponential growth engine dry. And of course, Warren Buffett's Berkshire Hathaway is literally the ultimate example of this in action. I mean, the stock grew an astonishing 80,000 times its original value. How? Well, largely because they paid zero dividends. Think about that. Buffett relentlessly collected insurance premiums and internal profits, and then he just reinvested every single extra dollar into buying other high-yield businesses, completely avoiding any unnecessary diversification into sectors he didn't fully understand. Next up, Section 4, Lesson 3, the double engine of wealth. So this is that rare, beautiful phenomenon where two massive thrusters basically ignite simultaneously to send a stock to the moon. Thruster number one is fundamental business growth, meaning the company's actual earnings increase substantially, let's say by 10 times over a decade. Thruster number two is public perception, which we measure by the price to earnings, or PE ratio. As the company proves its excellence year after year, the market is suddenly willing to pay a higher premium, expanding that PE multiple by 10 times. And boom, when a 10x earnings increase meets a 10x PE expansion, 10 times 10 equals your magical 100x return. Let's ground this double engine concept in reality for a second with a really specific case study from our source material, Relaxo Footwears. About a decade ago, their earnings per share was right around 1.6 rupees, and it steadily, predictably grew 10 times to 16 rupees. Concurrently, because the market finally recognized this incredible consistency, their PE ratio expanded from 10 all the way up to 100. So you take that 10x fundamental growth, multiply it by the 10x valuation expansion, and it resulted in a 1,000% price increase. It made it a truly spectacular 100-bagger. But listen, you absolutely must beware of the reverse double engine. If you buy into the market hype and overpay for a stock that already has an outrageously high PE ratio, you are putting yourself at extreme risk. Because even if the underlying business successfully doubles its earnings over the next 5 years, if that market enthusiasm cools down and the PE multiple shrinks in half, your stock price stays totally flat. That second engine working against you will completely destroy your capital growth. No doubt about it.
All right, finally, Section 5, the final test, vision and patience.
Identifying a 100-bagger is a massive analytical achievement, for sure, but it's really only half the battle. The immense psychological difficulty of actually pulling this off, that is the true test. All your brilliant analysis is utterly useless if you just panic sell the moment the broader market sneezes. Or, equally bad, if you get bored and sell just to secure a small 20% gain because you wanted a quick win. It happens all the time. The source material actually shares an adaptation of a famous investing maxim that just perfectly summarizes the exact mindset you need here. To achieve these life-changing returns, you must have the vision to see, the courage to buy, and the patience to hold. That last word right there, hold, is where 99% of investors fail. So I want to leave you with a final provocative thought to really shift your perspective today. Armed with the knowledge of skin in the game, the reinvestment engine, and the powerful double engine of growth, do you have the courage to buy the right companies? And honestly, more importantly, do you have the patience to step back and let them compound your financial destiny? Keep that question in the back of your mind as you look at your own long-term wealth-building journey.